Hey everybody, this is Alex Merced from alexmerced.com. And what I want to talk about today is the Republican tax reform bill, which is, it has its good parts and its bad parts. It's just, the problem is that it tries too hard to do too many things in complicated ways. Okay? To me, the elements of good tax policy is one, that it reduces the burden of taxation on people. Two, that it simplifies the existing burden, so it's easier to comply. I mean, it shouldn't be difficult to do your taxes. It shouldn't be complicated. Okay? And three, that it has less rent-seeking or least favoritism, so it's less influencing of people's behavior. So good tax policy should accomplish those three things. Tax less, tax easier, and not play tax favorites. So in this regard, it makes taxes more complicated, especially if you're a small business, because what they tried to do to cut taxes for smaller businesses that might file as like S corps, LLCs, they made it where you get a tax cut depending on what industry you're in. So there you're playing tax favorites, but on top of it, that means you have to file extra paperwork to determine if you're eligible for these benefits. It also plays favoritism with benefiting families and whatnot. And also, one of the things I do like is the elimination of the deductibility of state income taxes. Because the result of the deductibility of state income taxes is that it makes it easier for states to tax more at the expense of federal revenues. So basically, it creates federal deficits every time the state government taxes more, and it creates this really unhealthy dynamic. Okay, if it's not deductible, that puts pressure on states to not tax more. It actually becomes a disadvantage for the state to tax more, causing people to leave that state. Okay, and yes, it only primarily affects states that have income taxes, and particularly high income taxes. So states like New Hampshire, Texas, Florida aren't affected by this particular provision because they didn't have income taxes to begin with. But yes, so that part I like because that's reducing favoritism. Okay, basically making it easier for states to have an income tax. Cool. Other things are in there. There are some readjusting of rates and stuff like that, but nothing really transformational. So I started just thinking. If you watched a lot of my videos over the years, I've come up with a bajillion different tax reform ideas of ways you can arrange tax cuts. Oftentimes, generally always starting with like a flat tax, just because again, that's simple. While I am sympathetic to alternative tax systems like fair taxes, I mean ideal world there'd be no taxes. And when I say no taxes, I don't mean that there wouldn't be any mechanisms to fund governance. For example, if you want to see a sort of really interesting mechanism for funding governance, look into the cryptocurrency Dash. The cryptocurrency Dash literally has sort of a built-in tax into its protocol that is used to fund sort of democratically designated expenditures. I think maybe technology might leave room for sort of automating things like that that people will voluntarily participate in, but that's sort of real long view. Okay, so I do believe that we can get to that point of sort of a world that doesn't need to fund governance the way we fund it now, sort of confiscation. But that's not what we're at. So in today's world, I am sympathetic to an alternative, like let's say replacing income tax with something like the fair tax. Problem is, more than likely, you just end up with two taxes. So oftentimes I think of sort of ways you can reform the income tax in a better way. So in the past, I've started with a 20% flat tax and did certain things with credits to make it sort of slightly progressive, simple, without playing favorites, yet addressing a lot of the social aid aspects. And you can look up 20% flat tax Alex Merced on YouTube, and you'll find my video on that particular proposal. As I sat there and I kind of thought about this Republican proposal, I started thinking about a different idea. What if instead of taxing income, you just tax cash receipts? In the sense that means employers don't have to worry about figuring out what your payroll tax is or any taxes. You get rid of corporate tax, you get rid of all the income taxes, and you just tax people on sort of their increase in their cash position at the end of the year. Okay, so essentially, instead of your employer having to hire a payroll company to figure this out, you just have entities that are kind of already doing a lot of this tax calculation already. Banks doing it, in the sense that at the end of your year, you would have the bank issue you a statement saying, okay, this is the amount of money that you have that you didn't have with at the beginning of the year, based on your bank statements, based on where the funds were transferred from. So if you transfer it from your own bank account to another bank, it wouldn't count. But if it's transferred for some sort of other entity because you did affiliate marketing, whatever, that's not under your name, then that would count as a receipt, and then you would be taxed on your receipts. The reason for that is right now you get taxed on a lot of non-cash transactions. So then what happens is that when you're taxed on non-cash transactions and wealth, you don't necessarily have the money to pay the tax, and you're worse off for it. And because we do it based on just income in general, you put this burden on employers, and that's an extra expense to hire a payroll company for the employer, making running a business much more complicated. I mean, generally, most entrepreneurs just want to focus on running a business. And banks generally already collect a lot of this information and have systems to process a lot of this information, so it just makes more sense to have that to be the focal point if you're going to have one. And again, this isn't ideal libertarian world. The idea is, again, how can you simplify the tax code, get rid of less favorites, and make it easier, okay? And lower the burden. So again, in this case, you would just have some sort of flat tax on cash receipts, maybe with some sort of basic credit to give some basic progressivity. So the numbers that was running around in my head was a flat 20% tax on cash receipts based on your banking statements. If you make an income of under 100,000, then you can whack whatever your tax liability is in half. So essentially, you're paying 10% if you're under 100 grand, and anything above 100 grand, you're just paying a flat 20%, only on the cash received. So basically, money that you have tied up in a business venture that's growing in value, not getting taxed. Cryptocurrency transactions that are only done in cryptocurrencies, not getting taxed. It's only when cash hits your account. Cash that you received, that you had not had before, that you would be taxed on. Okay, so that would, again, keep it simple. So bottom line is, you would theoretically have the funds to pay the tax, and the tax would only be taxed on a very specific thing. Now from a banking perspective, that might be a little bit more complicated, but from the individual perspective, it's simpler for businesses to comply with. There's less favoritism, and it's easy to understand. Whatever cash you received, 20%. And if you made less than 100 grand, whack that in half. But again, that's just me being a tax wonk. So hopefully you guys found this interesting, just kind of thinking about tax policy and talking about the tax proposal on the bill, which is a mild bill. There's nothing hugely transformational about this bill aside from the state tax deductibility thing. And overall, it's questionable whose taxes will increase and whose taxes will decrease. And it doesn't seem like the tax code has gotten any simpler, which to me is like the most important thing that can be done that's on the table. So I'll see you guys in the next video. Have a great day and enjoy. My name is Alex Brissett.